Another video, and in today's video I want to give you guys an update on the Japan basket as well as the EURJPY and GBPJPY. Also want to give you an update on the dollar index as well as the EURUSD and GBPUSD. If you are new to the channel, a sub would be appreciated as I provide valuable educational content on a daily basis. If you enjoy the video, a thumbs up would be appreciated as it really helps drive the YouTube algorithm. Now let's just jump straight into it. First things first, apart from the interest rate decision and all the fundamental data that I covered yesterday with the indices or with the stock market updates that I've done, we had the US ISM manufacturing PMI that came through yesterday. The PMI basically measures the activity level of purchasing managers in the manufacturing sector, and anything above 50 indicates expansion in the sector. Anything below indicates a contraction, and you can see we've been relatively above the 50% over there. The PMI is also widely seen as an accurate and timely indicator for business conditions that helps analysts as well as economists to correctly anticipate changing economy trends in official data series as well. I can see it's doing quite good. Now we're going to start with the Japan yen. Now Japan yen has been very interesting because we know that the price has been quite bearish, and if you don't know why this is, it's because the reason why the Japan yen has been so bearish is because interest rates in Japan has not been touched, even though the rest of the world had gone forward and hiked interest rates. Now we saw with the currency pairs, any currency pair trading against the yen, for instance, you can see has been, if you look here, you can see has been quite bullish, or not even there, but you can see has been quite bullish for about 5 months straight, and only started that correction from there. But in Japan, they decided to keep interest rates as low as possible, and as a result of that, investors are normally attracted by countries who hike interest rates because it's always a better return for their investment. Now, looking at the Japan base basket, which is the currency index for the Japan yen, if we are bearish on the Japan yen, that means we are bullish against any currency trading against the yen. So we're going to start with the analysis on the Japan yen. Now here on the monthly time frame, what do we have? Now from a monthly perspective, we can see that this was the last structural level that the market had created that acted as a strong level of support. Once support gets broken, it then becomes resistance. Now we can see the market is still a long way from home. Now there is a possibility that we could potentially see the market continuing higher, and the quickest way for this market to recover is when Japan announces some interest rate hikes there as well. So we can expect this move to the upside on the weekly time frame. What do we see? Now from a weekly perspective, it's quite clear. The market is currently testing this structural level that it had created here on the weekly time frame. Again, this level acted here as a level of support, and you can see the market is now back to test it as resistance. We also had this massive impulse. So after an impulse, you expect a correction, and if you take your Fibonacci from the high to the low of this massive impulse, you can see how the market is approaching to test the 61.8, which is known as the golden ratio. So there is a possibility that we could see the market slightly go up and then start this move to the downside there as well. Now here on the daily time frame, what do we see? Now from a daily perspective, once again, you can see how the market had printed this overextended W formation. Now after an overextended W formation, you normally expect to pull back to the left leg before that continuation to the upside. The market also printed this massive impulse. After an impulse, you expect a correction, and if you take your Fibonacci from the low to the high, you can see how we do have a 0.382 Fibonacci level that's lining up perfectly with the left leg of the overextended W formation that we expect the market to pull back to. And because we expect the Japan yen to decrease in value in the short term, we do expect every currency trading against the yen to increase in value there over time. Now if you look at the daily time frame on the EURJPY, you can see that this was the very strong structural level that the market printed, and this was acting as a level of resistance. The market tested it as support and is back to test it as support once again. You can see what happened when the market came to hit that level as well. We got this massive impulse. Now if you look here, we have this massive impulse to the upside. Here we've got a massive impulse to the downside, expecting that correction up, as we expect a correction down on the Japan basket there as well. Now if you take your Fibonacci from the high to the low of the impulse, we should get a 0.38 to pullback lining up with that structural level there as well. So about that, okay, so we do have a 50% pullback over here. We do have this weird looking overextended information, which is considered a bearish pattern from a technical perspective. Now because we expect the yen to decrease in value, we can expect the EURJPY to increase in value in the short term for the market to complete that correction, as we identified on the Japan basket there, the Japan basket there as well. Now on the GBPJPY, it's a lot more clearer. You can see the market printed this overextended WM formation. After overextended WM formation, expect to pull back to the left leg before that continuation to the downside. Market also created this level of support. Once support gets broken, it becomes resistance. Market also created this equal low that we can see over here. The market also printed this massive impulse. So after an impulse, you expect a correction. And if you take your Fibonacci from the low to the high, we do have a 0.382 pullback that's lining up with the information. So we can expect the market to continue slightly higher. We could potentially see the market go hit this level first. Alternatively, if the market wants to go deeper, that would be even better for us. This you know, if you do decide to get into this market quite early. Next up, we do have the dollar index that has been quite bearish since the July, but like I said in the last breakdown that I did, we wanted the market to close with this massive wick, because that just means on the weekly time frame is just a correction. Now if you look at the price action that we got on the dollar index, we got this impulse, we got that correction, which is probably past the 61.8. If you take your Fibonacci from the low to the high, you can see, yes, the market had printed and has gone way past the 61.8. But like I said, it would be good for us to see the market that had broken above the strong level of resistance. That resistance is basically acting as this level of support now. So we could potentially see a further retracement, but the market is about at this level that we expect the market to test, reject, and continue to the upside due to positive fundamental data. On the daily time frame, the market is currently testing this very strong structural level that had acted as a strong level of resistance. It got broken. It's back to test it as support for the first time in ages. Now, once again, we also have this level over here that the market had just broken below, acted as support. Once support gets broken, it becomes resistance. The market also printed that massive impulse. After an impulse, you expect a correction, taking the Fibonacci from the low to the high. We can see how the market had printed this 38.2. That's once again lining up perfectly with that structural level that we can expect the market to pull back to before getting any continuation. Now, same principles apply here, because we do expect the dollar index to slightly increase in value. We can expect the EURUSD to decrease in value. The EURUSD had printed this massive level, or the strong level of resistance over there. The market had also been stuck within this liquidity, if I should call it, this consolidation phase, and we had that fake out there once again over here. So we had this level that the market had been consolidating in. It's quite difficult to trade this range because of all this liquidity wicks. The only way for us to look for any long-term opportunities, if we get a daily close above that, then on the retest start looking for that buys. Alternatively, the market could do the same thing here, which is just a liquidity grab. And if you remove all of this and you go down on a line chart, you'll see that this is the actual structural level. Sorry, this would be the actual high of that consolidation phase. Going back on the candlestick charts over here, you can see the market had broken above that level. But these are considered liquidity wicks in the market, and because the market had not given us a clear break out of this level, we cannot look for any buying or selling opportunities. Now, the best way to approach this is it's quite clear. Okay, if the market does give us a clear break above this level, then we can start looking for buying opportunities. But that would mean that we are contradicting our DXY analysis. So we have to be reactive and not predictive. So based off where I'm sitting, I expect the EURUSD to decrease. Sorry about that, I'm not sure what's going on, but we expect the EURUSD to decrease in value because of the DXY getting stronger. But again, like I said, we have to be reactive and not predictive. If we do get a daily close above this level, then by all means we can start looking for buys on the market as well. Now, this was the last analysis that I did. You can see the market printed this inverted head and shoulders, a W formation, and that's exactly where we had that pullback and the market didn't continue higher. So I guess it's time for an update here as well. Now you can see the GBPUSD is testing strong level of resistance. We can expect the market to slightly pull back from that level there as well also. But here we face with multiple structures, so we can see that this level over here in the market had also acted as a strong structural level in the market. That has support there, support, resistance, broke above that. So the best way to approach this, can we expect GBPUSD to weaken in the short term? Yes, we can. So we can expect the market to continue lower from where it is now, and then we can obviously start monitoring price action from this level. A break below this level will make way for the market to move slightly down lower there as well. Now that's all from my side. Thank you for your time, and as always, cheers for years, my good friends.